Hi everyone. In this third and final video for Gerber Chapter 9, I will focus on a discussion surrounding the issue of whether or not current account deficits or trade deficits are harmful to an economy. I won't spend time talking about Part D and E. These two sections are very short in the textbook. They're basically just definitions, so I'm going to leave it to you to look at the one page of notes I have on each of these topics and peruse that part of the book. I'm going to spend a little extra time focusing on the question of whether or not current account deficits are harmful because it's been in the news lately. The Trump administration has been focusing efforts on dealing with unfair trade practice issues by China, but that unfortunately got conflated with the issue of the United States having a current account deficit and whether that's harmful. And that shouldn't have been the case. Those are two distinctly separate issues. There's unanimous agreement around the world and across economists that unfair trade practices by China, something needed to happen eventually to deal with that. But that's a completely different issue than whether or not a current account deficit or having a trade deficit is harmful to a nation. So hopefully I can clarify some of that and shed some light on some of the key points. All right, start on page 10. And I'm going to go a little bit beyond what our textbook discusses for this issue, but let's just first go over what is in the textbook. The main benefit of current account deficit, because a current account deficit automatically implies that you have capital flowing in, savings of foreigners flowing in. The main benefit of a current account deficit is that it enables a country to have more investment than it otherwise would. Another benefit of current account deficits is technology transfer, which is the spread or the introduction of new technologies, new management techniques, and new ideas to a host country, the recipient of the capital inflows. So this is especially valuable for poor developing nations, but it's also important for high-income countries as well. So what is the downside of a current account deficit? Again, having a current account deficit implies that you have capital flowing into your economy, and that creates the vulnerability for capital flight. Or sometimes the term sudden stop is used, which means more or less the same thing as capital flight. It means a sudden reversal of capital flows. Lots of investment was flowing into your economy from abroad, and it suddenly reverses course. And whenever that happens, it has negative effects on an economy, because if there's a sudden drastic reduction of credit available, then the spending has to be cut, both government spending and private consumption spending. Capital flight is also especially dangerous for countries that borrow in foreign currencies, and that foreign currency is usually the dollar. So recall from Mankiw Chapter 19 that capital outflow depreciates the domestic currency. If you've borrowed in dollars and your domestic currency is, say, for example, pesos, then after a depreciation, you will need more pesos to pay back every dollar of foreign debt. So capital flight, in addition to lowering consumption spending and government spending, forcing cuts in those types of spending, capital flight also can make it very difficult to repay foreign debt. And that has been a central issue in all of the major international financial crises over the last couple decades, the ones that we keep mentioning. The peso, the tequila crisis in Mexico in 94, the Asian financial crisis in 97. One point our chapter makes is that the size of the current account balance, while it's acknowledged universally that having a very large current account balance is a point of vulnerability, it's not a guarantee that a country will ultimately be hit by capital flight. So it says the size of the current account balance was not a good predictor of whether or not a country was drawn into financial crisis during at least the most recent financial crisis in 2007, 2009. There's no absolute threshold between safe and dangerous levels of a current account deficit, but there's some agreement that 3 to 4% of GDP, a current account deficit that is 3 to 4% of GDP, begins to raise red flags, while 7 to 9% of GDP is considered extremely risky. So looking at the current account balance as a percent of GDP in the United States, the highest we have been in recent times was in 2006. We got up to 6%. So lots of concern was raised around that time as to the size of the current account deficit in the United States. And by the way, why are we looking at the current account deficit as a percentage of GDP? For the same reason that we look at lots of other variables as a percentage of GDP, to put them in perspective of the size of the economy. A growing current account deficit that is increasing as the same rate as the overall economy implies a burden of indebtedness that is roughly constant. If your economic growth is occurring at a pace that is as fast as or faster than the current account balance, even though the current account balance number is getting larger, it doesn't imply an increasing debt burden if your GDP is growing as fast. So it can be misleading to cite current account deficits in dollar terms. It's more appropriate to express it as a size of GDP. Key point from the textbook. Current account deficits enable a country to invest more than it could otherwise, which has a beneficial effect on national income if the investments are made productively. If deficits are too large, they increase the vulnerability of a country to sudden outflows. Let's just go slightly beyond what is in the text to get a little bit more perspective. When current account deficits are discussed, they're often discussed in the context of this so-called external balance. So let's define that. These are notes from a different textbook in international economics. So hopefully this gives you a broader context in which to think about current account deficits. Macroeconomic policy generally has two goals in an open economy: internal balance and external balance. Internal balance refers to producing a level of GDP that is equal to potential GDP and price stability. External balance, and I like this sort of broad definition, external balance is attained when the current account is neither so deeply in deficit that the country may be unable to pay its foreign debts, nor so strongly in surplus that foreigners are put in that position. So international economics textbooks usually define external imbalance as balance in the country's current account. But that definition is not appropriate as a general rule. Moreover, external balance is difficult to define with as much precision as we can define internal balance. There's no unambiguous benchmark like full employment that we use to define external imbalance. So it really depends on the circumstances. A current account deficit means the country is borrowing resources from the rest of the world that it will have to pay at some point in the future. But that's not necessarily an undesirable situation. For example, if the investments are profitable enough to generate a return that is high enough to repay the principal and interest on those loans, then it is no problem. Similarly, a current account surplus may be no problem. It could be the case that domestic savings can be invested more profitably, more efficiently abroad than it could be at home. There is also an idea in the literature that a trade deficit might make sense on an intertemporal basis. So maybe you're importing today and building up productive capacity in your economy, and in the future that you'll be exporting after you build up that productive capacity, and your current account deficit will eventually shrink. This matches the real world data to some degree, that it's often the case that very poor countries run a big current account deficit because they can't generate enough savings to fund their own investment. No realistic policymaker would want to adopt a policy target to balance the current account at all times. So while the target level of the current account is generally not zero for most countries, governments do try to avoid extremely large surpluses and extremely large deficits. As we've said, the biggest danger related to an excessive current account deficit is the danger of a sudden reversal in capital flows, capital flight, or sudden stop. The problem related to excessive current account surplus, it implies that investment in the surplus country is potentially lower than optimal. There's always a risk that those foreign loans won't be repaid. Also, just like China today, surplus countries, and Germany as well, can become targets for discriminatory import barriers. I'm going to just reference a few other articles that I've placed on Blackboard in case you want to reference these. These are articles that I found insightful. So the bottom line is a trade deficit good or bad? It depends on the factors that give rise to the trade deficit. It could be a bad sign. It could signify a competitiveness problem. But it also, on the other hand, might signify a highly productive growing economy, an economy that has a lot of investment in excess of domestic savings. It also may signify reckless fiscal policy, because as we talked in the last video, the relationship between budget deficits and current account deficits. A budget deficit drives up the current account deficit. Or it could signify a consumption binge. That essentially refers to a situation where the capital flowing in from abroad, instead of being used to finance productive investment, it's essentially used for domestic consumption. A trade deficit may reflect the intertemporal trade that we just discussed recently. And one reason that you might see that is related to demographics. So older societies that have lots of people aging, it makes sense for those societies to have a very, very high level of savings, and therefore they're more likely to have a trade surplus. Here was a quote from another article that was insightful in understanding the risk of current account deficits. The United States is unique for a couple of reasons. A major reason is because of capital markets in the United States are extremely safe, relatively lucrative, relatively stable. We are a target of international investment around the world. So there's always going to be a draw to have capital flowing into the United States. Also, there's always going to be a large demand for dollars because of the role that dollar plays in the global trade system. It is the preferred currency that is used in international trade around the world. So this article makes the overall point that it's extremely highly unlikely that the United States would be subject to a sudden capital flight because of the central role of U.S. financial markets, U.S. capital markets, in other words, and the primacy of the U.S. dollar. And it comes to the conclusion that current account deficits in the United States are not so much a result of structural imbalances, like, for example, a lack of competitive goods and services being produced, but rather the trade deficit is to some degree driven by the fact that we have such a large amount of capital inflow into the United States. Okay, hopefully that has helped you understand a little bit more about the pros and cons of trade deficits. So just a quick review here. Everything in black was discussed in our textbook. The big benefits are more investment, lower interest rates, which means cheaper borrowing, not just for firms investing, but also for consumers and governments. So because our government can borrow at such a cheap interest rate, that's less taxes that we have to pay to cover the national debt and the deficit. The big downside, a large current account deficit is a definite vulnerability to capital flight or a sudden stop in foreign financing. And we've talked through those negative effects that come from capital flight. And the fact that it can also cause an exchange rate depreciation, or in a worst case scenario, a currency crisis, which just means a drastic reduction in your exchange rate. Currency crisis is harmful because your imports suddenly get more expensive. It pushes up inflation in your economy. If you have, to the extent that you have foreign goods and services in the market basket, the higher the overall price level. And it's more difficult to repay debt denominated in foreign currency. That's another reason why the United States is less susceptible to capital flight. The United States and many other developed nations borrow in our own currency. So the United States typically borrows in dollars, but smaller and emerging market economies can't always borrow in their own currency. They very often have to borrow in foreign currency. And so that brings about exchange rate risk. A couple other factors that our book did not mention. Growing foreign ownership of domestic assets is another consequence of the trade deficit, and that is quantified by the international investment position, which is part E of this chapter. A rising percentage of U.S. income goes to interest and dividend paid to foreigners. So when you have a current account deficit and hence capital inflow, part of paying back that debt and paying dividends on stock ownership, it comes out of U.S. income. So it's a transfer of wealth from U.S. citizens to other citizens to some degree. And so, for example, the interest paid on government bonds that are held by foreigners, that's part of our tax revenue that goes to foreigners to pay interest. One last aspect, open financial markets can be risk amplifying. So sometimes financial crises have contagion effects. That means they go from one country to another country quickly. We'll talk about that in chapter 12. But a good thing about open financial markets is that they can also be risk sharing. So for example, if we have a fall in the US stock market, as we are right now, part of the losses are borne by foreigners. Okay, that concludes our discussion of the pros and cons of trade deficits. You will have a short assignment, podcast quiz related to the downside or the concern about having a trade surplus that is too large, and it will use Germany as an example.